Hi everyone, welcome to our live panel hosted by me, David Dawson, the CEO of Markland Hill Wealth, MHW. I'm really pleased to be joined today by three of our trusted investment partners. We've got some real specialists on today, which is great to have. So thank you guests for coming on board. Stephen, Claire and Henrietta, if you will please introduce yourselves, that would be great as we start.
Good morning. My name's Stephen Blakemore. I work at Rathbones in our Kendal office. I've been in investment management now since 2007, so around 20 years coming up to it now. And I know I don't look it, but I've got a background in accountancy and finance. I grew up in Wigan and I live in Lancaster now.
Great.
Hi, I'm Claire Bennison. I'm a Director of Investment Solutions at Tatton. I have been an investment manager for over 30 years, so I definitely don't look it, hopefully, Stephen. And I'm very happy to be on the call, David.
Thank you.
Good morning, everybody. I'm Henrietta Walker, Head of Investment Specialists at McDonald, and I've been working in investment management for over 30 years now as well.
Thank you very much, everybody. So what we're here for today is to talk through recent market movements and what's behind them and what it means for our clients. So if you're watching this, hopefully it'll be of value to you. What I will say as we start is that times like this, they can be unsettling for everybody involved, and it's really interesting to talk through the detail of what's happened. However, before we do, we want to start by reinforcing our vision at MHW. Our vision at MHW is empowering people to discover the way to their best lives. And some of that really is about understanding the journey and, what happens when you are wanting to get to a certain goal in life, a certain financial planning goal. It's important to understand the journey. And to be honest, for some people, their best life might just be having peace of mind and kind of understanding that whilst we need to be invested to get to where we need to be, then actually peace of mind through the journey, is something that is really important. So we'll bear all that in mind as we start to talk through some of these things. And with that, let's get started. So what's happening in the markets? It'd be really interesting to know what's been moving the markets. Stephen, I'm going to come to you first, if that's okay. Can you give us a quick recap on what's going on with Trump and what's going on with the world markets?
Yeah, so I'll try and frame it. So over the last couple of years, the North American market, it's had back-to-back 20% rises. So we've got to think about where we've come from. We've come from quite an elevated level. And what's driven that has been the AI trade. So we've had what we call the Magnificent Seven. And that's seven companies that have really benefited from this AI boom. So the likes of Nvidia, Tesla, Microsoft, Amazon. So if we take step back to last year, first we had the DeepSeek model that came out of China. That kind of spooked the AI industry to think they can get a lot of this processing power for a much lower cost. So that's kind of started the initial sell-off in the Magnificent Seven, and which is really a big proponent of the S&P 500. If we think about last year, we had the UK budget as well. So that started to make the gilts decrease in value and increase their yield because we had the left-leaning government take power. They stood on a platform of growth, but then they raised national insurance 18% and also started to fiddle the fiscal rules as well to borrow more. So they say the markets is like a small child. It can only focus on one thing at a time. And now it is the tariffs. So we've had the 2nd of April, we had the Liberation Day that Trump announced. And he used a very strange calculation on trade deficits and used that to calculate a tariff figure. So 90% on Cambodia and only 10% on the UK. And the market was not expecting this level of tariffs and be so chaotically rolled out to be so different levels to different countries, even though Cambodia is not going to be able to import as much as the US exports. So that's kind of spooked the market. Add on top of that, we had Elon Musk with his Doge department going through the federal government, cutting a lot of jobs. So the overarching theme of this market now is uncertainty. We don't know how much Trump is going to push forward with this tariff agenda, what levels we're going to settle at, because a lot of the MAGA movement have said it's going to be a lot of deals that come through. That is going to have to be a wait and see. What happens after this 90-day pause? So at the moment, it is about having a diversified investment strategy to manage all this uncertainty.
Superb. Thank you, Stephen. Claire, we know with events like this, with every action, there is a reaction. What economic ripple effect are we expecting here?
Well, I think Stephen's done a great job at setting the framework, and this is definitely politics and economics colliding together. So, I mean, I haven't read any reports from any economists who says tariffs is going to be a win situation coming through for anyone. So, this is very politically driven, but I think it's important that we take a step back and see where we've come from. So, Stephen's mentioned that we've had back-to-back very strong equity moves in the last 2 years. But economically as well, the resilience of the US economy has been clear to see. You are expecting to see more unemployment to come through, but it's coming from a very low base already. We've had a really good, strong job market in the US for quite some time. The resilience of the consumer spending and consumers in the US has also held up very well. And as we go into the Q1, obviously the data, everyone is thinking, well, the data we see in February, what we see in Q4 or the Q1 earnings, they're not so important now. We want to see what's going to happen coming forward, but it is also where we're coming from. So yes, growth is going to slow more than expected at the beginning of the year. The risks of recessions have definitely increased, but I don't think it's a certainty that we will get there. But because we're coming from a very high base of strength, this weakness has, is there's a buffer zone for the economy to come through there. But you come back to the old adage, if the US sneezes, the rest of the world gets the cold. This is why you've seen it cascade globally, even though this is very much a Trump US political decision that's had a ripple effect across the world.
Thank you very much for that. I think what's interesting, you mentioned there, the global effect, and it'd be interesting, Henrietta, just to outline the different reactions across markets and asset classes. If you could just run us through that, please, that'd be really great.
Absolutely. Thank you, David. And I think it's important to pick up on setting the scene as Claire and Stephen have done this year. And really, we'd seen this huge rise and very strong performance of the Magnificent Seven AI-related stocks, as Stephen was saying. And then we started to get concerned in January on news of the Chinese startup, AI startup DeepSeek. And that started to put fear into investors because there was so much hope, value, and expectation. And we started to see those stocks sell off since then. But what's interesting is that as that sell-off has broadened out and has taken in not only the US equity market, but other equity markets across the board. And people have started to worry and say, what does this mean? But obviously, the tariffs are going to have a massive effect. But it's quite interesting, after having seen such an outperformance by US equities, on a year-to-date basis, you might think, well, everything would have sold off. But actually, if you're looking from the point of view of a sterling-based investor, some markets are actually up a little bit year to date. So there hasn't been indiscriminate selling. There's been some pockets of hope, if you like. And one of those has been the UK equity market. Now, the UK equity market, even before any of this, still looked incredibly cheap versus the US. So it's quite pleasing that it has done reasonably well on a relative basis. And then also the European equity market, and particularly Germany. And obviously all the focus is on tariffs at the moment. But in Germany, for example, they've managed to have a debt rate removed to increase their spending on defence, which they're now going to have to do because the US isn't going to support European economies in terms of defence as much as it has done in the past. But that news has really helped the German equity market, which is up, quite a bit year to date. So it's not all doom and gloom. Obviously, we don't like it when equity markets sell off, but more than ever, this is really putting forward the importance of being selective in terms of investment. And perhaps during 2023 and 2024, investors could just buy a tracker and everything looked fine. It now looks that perhaps active investment, active stock selection might be the way forward. And just briefly, as we've been already hearing today, the net effect of tariffs is going to be negative for growth and will boost inflation. And of course, as a bond investor, that's not particularly good news. And we have seen bond markets sell off, particularly the US bond market. That's been negative. And I think just one more quick thing for investors. We're actually seeing the dollar sell off versus other currencies. And if you look at the dollar on a trade-weighted basis, it's actually now at a 3-year low. So some quite significant moves there.
I mean, if I can just pick up on Henrietta's points there. So on the growth and the inflation, I think I heard someone describe this, is that you've got 2 children, you're taking them to the park and they're both running in different directions. So which one do you choose? And I think this is absolutely the key problem for the Fed at the moment. Do you chase after inflation and therefore leave growth, or do you chase after boosting growth and then you may have unanchored inflationary pressures coming through? And it's not an easy situation to move on. And from the boosting of the UK and European equity markets, that is really key, because the defence spending that's coming through is going to boost manufacturing, which has been a laggard in both of those countries for quite some time. So it's not all bad news, but there are some really tough decisions for central bankers to make, and I wouldn't envy them at the moment.
No, indeed. Thank you very much both for that. That was really interesting. And I think there's some interesting points that come out of there which build up the wider picture. You will have seen on our MHW website, we had views from our own chairman, David Atherton, and his message in simple was, don't panic. The reason he supported that kind of mindset really was because he was talking about the fact that these kinds of decisions that are being made at the moment and the market movement is government policy driven, which is a lot easier to navigate from a market standpoint, or certainly recovery can be faster on certain markets than it would be if it was, economic fundamentals. Be really great to get your opinion on that, each of you, if that's okay, because obviously, like you said there's still some tough things to navigate, but actually it's not all bad news as well. Firstly, what do you think of the don't panic sentiment?
Yeah, I would echo David's sentiments, really. First thing I would say is speak to your advisor, focus on your long-term plan. We are one part of your overall financial plan, and we'll help you achieve those goals. But if you revisit that can give comfort in times of market stress like this. Like we said when we opened up the meeting, we've had 20 to 30 years experience managing money. We've seen volatility like this before, and it helps us to rebalance portfolios and take opportunities where we see them. We've seen that weakening dollar. Gold has gone borderline parabolic. Would I be trimming that back to buy equities yet? No, but we do have that in our crosshairs. So there are pockets of the portfolio that's doing well. And when we decide to rebalance, we will be taking opportunities. We'll be selling to the optimist and buying from pessimists. We've been through COVID, 2008 crisis, Brexit, the Truss mini budget, Russia, Ukraine, and that's just a few in the recent history. And like we've said throughout, this is very much politically driven, and it can turn on a tweet. You know, we saw that tweet that came out. First, he said, now's a good time to buy. Then he decided to do the 90-day pause. And we saw the NASDAQ up 11, 12% in a day, which is just unprecedented. So you want to be invested in this market. You don't want to be sat on the sidelines when things like this happen. So I wouldn't be rushing lots of cash into the market now. But if we are invested, we can drip feed, we can rebalance slowly. And there are things that could change, you know. Trump has talked about his deals. We could just have some positive political news. The market would eat that up and start to rise. And also the Fed, like Claire touched upon, the Fed might be pressurized into making adjustments to support growth, which could have a boost to the equity market again.
Right. Any other comments?
Well, I mean, I would echo Stephen's, a client's long-term goal is set by the advisor, and that's the journey. And on a journey, you're going to see little detours, the volatility, and that is to and that's for the investment managers to navigate through. And it's the old saying, it's not time in the market, it's time in the market. When you have this level of volatility, if you try to react every time, the chances are increasing that you will get topped and tailed on that. And because there's just so much noise. Stephen mentioned you wake up in the morning and has he sent out another tweet on this? But I think it's also worth thinking in the second half of the year. There are tailwinds that are going to come through or likely to come through. Trump has been very focused and delivering actions on what he said in his campaign trail. But he also said he was going to cut taxes, corporation taxes. He was also highlighting that he's going to deregulate key sectors or try and deregulate. These are positive tailwinds potentially to come through in the second half of the year. So don't try and time these moves. I don't think it's really possible, but it's time in the market. And, capital markets go left to right, go up. Otherwise, none of us would be here now. And you wouldn't be advising on these investments. I would also say in today's world, rather than maybe 30 years ago, the breadth of investments you can use, whether they're direct bonds, direct equities, or even structured notes and things. So you've got a whole range of different investment styles that provide a different type of risk return that can help bring down the overall volatility for a client's portfolio, and that diversification, which has already been mentioned, is absolutely critical.
Great. Harriet?
And Henrietta, yes.
Sorry.
Yeah, I'd echo both of those things, but markets hate uncertainty, but as everybody's been saying, we've come through a lot over the last 3 years. I was actually just reading an article, I think it was by one of the big US investment banks, saying that markets can get over periods of uncertainty. And in a year in which there's an event which is very uncertain, in 8 out of 10 times the next year you're actually seeing positive returns in equity markets, and of course the danger is if people try to time the market, they'll miss the good days, and that can have a really significant effect on overall returns.
That's really interesting, and I think again now to bring it back to our clients at MHW and where we are. One thing I will say as we kind of talk about client portfolios is this webinar is set up really as a debate, a kick around of opinion of where markets are and where they're going, a little bit of information to help our clients. It's certainly not financial advice from any of us. And, in terms of that, we welcome conversations with individual clients, and we'd love to talk and give you advice further to, what we've already done if you feel the need to. Clearly, as we've already said as well, these market movements and managing your money is one part of an overall plan. And we are confident that our investment committee, working constantly to challenge investment managers on decisions made, strategies, and their long-term sustainability and aligning with client goals. That MHW, that is what we do. We've got an investment committee that meets regularly and talks regularly. Ironically, we have chatted this morning before this very webinar. So it's interesting to kind of get your individual takes now, without it being any kind of advice, on what you think clients might be thinking about their individual portfolios at the moment, whether cautious through to adventurous. It'd be great to start with Henrietta, your views of what should clients be thinking, or what might they be thinking right now?
Well, as you're saying, it's important to have the conversations with your financial advisor to ensure that you've got an appropriate level of risk in portfolios. But I think also what's more important than ever is to have adequate diversification across different assets. Bonds, you get a decent income from bonds now. And in terms of geographical asset allocation, to be diversified across the different equity markets, as we've been hearing, there are areas that offer some pretty good value at the moment. And also the role of portfolios, which can provide a buffer in times of extreme market. Really, diversification, having the appropriate level of risk in portfolios and having an appropriate time frame.
Excellent. Any other comments, Claire, Stephen?
No, I would echo what Henrietta said there. Your risk profile, your time horizon is absolutely critical. Your objectives, whether it's income growth or a combination of both, is absolutely critical. And it's also, again, keeping focused on the longer term, your goals longer term with your financial advisor, and not really trying to avoid the literally the day-to-day noise that is coming through at the moment. It is it is nice to see fixed income actually, holding up well. There was a whole load of reports last year that the 60/40 portfolio was finished, and actually it's nice to know that all your different asset classes are actually functioning as we would expect them to be at this point in time. So keeping focused on your longer term goal, and the volatility will subside.
Yeah.
It doesn't stay at this level of volatility indefinitely. It does subside, and further clarity will come through.
Superb. I think when we host webinars like this, generally we do talk about risk and caution, and as I've said at the beginning, giving peace of mind. For some clients, they will see the contrarian view that there will be opportunities in a market like this. Can anybody share some opinions or insights into where we see potential opportunities right now?
Yeah, I think it's been mentioned before. European equities, for one, we've had that change of stance from the German government about loosening the fiscal restraints, and the way that we're going to have to rearm, because the North America are not going to support the Europeans and their allies like they did before, especially under this Trump administration. So that's going to have some stimulus towards the economies in Europe. Other than that, there are other asset classes mentioned: fixed interest, bonds, gold as well, having some element of gold, that safe haven in portfolios. It's a really good diversifying asset. Claire talked about structured products as well. You come speak to your investment manager, we talk about structured products can have some level of consistency in portfolios. Another area
And
we're
also,
looking.
I'd say just there, Stephen, talk to your financial advisor if you don't know what a structured product is. We
Oh,
can
absolutely.
explain different types of investments and asset classes, no problem. Sorry.
And there's only one final one would be hedge funds that we look into. Again, speak to your financial advisor and your investment managers to explain hedge funds. So those are the traders that can take bets against certain assets as well. So they can make money in falling markets. They can look for trends. One trend we've seen is the gold price going up. The other trend that was talked about was the dollar weakness as well. They can make money off that one as well. So it all comes back to diversification. There's lots of assets that we can invest in to get you a positive return in this market.
Excellent. Any other comments? No, great. I think the one thing that I would say is, you've mentioned diversification there. Someone did mention active management earlier. Does anybody just want to touch a little bit further on the difference between active and passive and why you believe this is a position for active right now?
I think that was me, so I'll jump in there if that's all right, David. Yes,
Sure.
absolutely, and that's a very good point. So basically, passive investment management is buying what we call trackers that are designed to track market indices. So that's based on the market capitalization of companies rather than anything else. So you're just buying more of the big stuff, if you like. Now that's great when the big stuff is doing well. So as we heard earlier, 2023, 2024, those big tech companies doing really, really well. And that looked like the way to make the best returns in the markets. But however, that has led to some very distorted valuations. So the expensive company, big companies looking really expensive. Now that's fine until it starts to go the other way. So people have now become concerned about the AI trade, if you like, concerned about the valuations, and that started to underperform. So what we call active management is buying companies based on fundamentals, based on their individual growth rates, whether they look cheap compared to earnings, for example. And in these markets where you're seeing a lot of challenges, both political and economic, we've seen a return to fundamentals whereby investors are looking for companies in markets that look cheap. As I said earlier, for example, the UK, which is much cheaper, even now still, than the US. I'm looking for companies, active management is looking for companies that look cheap as well compared to their competitors. So it seems that perhaps after a long time when passive strategies have done better, that the environment may now be much better for active managers.
Excellent. That's really helpful. Thank you. Anybody want to add anything there at all? No?
Yeah, I'll echo Henrietta, because when we're talking to some clients about active management, that's been the pushback sometimes. Why don't I just buy an S&P 500 tracker? It's for these times that you don't do that. Unless you've got a very high risk tolerance, you are investing in the tech companies very heavily with an S&P 500 tracker. Now is the times that diversification really earns its crust, if that's a phrase.
Yeah, absolutely. I was having a quick look this morning before I came onto this call, and there are two sectors in the US that have actually performed or given you a positive return year to date. So utilities and consumer staple stocks, not very exciting, but that's what people might go to when you're seeing this heightened uncertainty in the markets.
Excellent. That's really valuable information. Thank you so much. I think we'll wrap it up there if that's okay. Just to say, for any of our clients, whether you have an active, passive, cautious through to adventurous portfolio, clearly your journey is your own, and there'll be different reasons that you've been recommended certain portfolios. And if you've got any questions and you want to go through the journey, then we are always here to talk, and we welcome these conversations. So excuse me. Thank you so much to our guests for taking part. It's been really valuable. For any clients, again, who want individual advice, remember, this isn't advice. This is just an opinion and a discussion on where markets are up to at the moment, and some really valuable information there. These moments of volatility aren't the whole story as well. Clearly, as we've said, things can change very quickly. It's all part of the journey, and we are here with you to walk through it. So I've got to say thank you, because you guys are some of the heavyweights of the industry who've taken the time to come on and really discuss things for our clients. So thank you so much for that. And yeah, we will be hopefully doing these things fairly regularly. If you would like to see more of these things, clients, advisors, contacts, friends of Markland Hill Wealth, MHW, then please do let us know. We'd love to really add value to clients and put on things that are of value. So thank you again, and we hope that you'll join us soon for our next update. Thank you, everybody.
Thanks for having me.
Thanks, Dave.
Thanks.